On February 24th at 0830 Eastern Time, global markets opened sharply lower after confirmation that the White House would move forward with a sweeping 15% tariff framework on a broad range of imported goods. Within minutes, S&P futures slid, European indices followed, and gold spiked above key resistance levels as capital sought safety. This was not a rumor. It was not a negotiating leak. It was a policy signal, direct, deliberate, and global in scope. The announcement represents more than a trade adjustment. It marks a structural shift in the world's largest consumer economy toward tariff-based leverage as a primary instrument of statecraft. The window is narrowing, the clock is ticking, and the military equation, though not visibly kinetic, is already being recalculated in strategic planning rooms across Washington, Beijing, Moscow, and Tehran. The proposed framework calls for a broad 15% tariff applied across multiple categories of imported goods, extending beyond targeted sectors and into generalized trade flows. Unlike prior tariff rounds focused on specific countries or industries, steel, semiconductors, electric vehicles, this framework signals a more systemic posture. Who is involved? The United States as the initiating power, China as the primary manufacturing rival, the European Union, already navigating industrial policy tensions, emerging markets deeply integrated into U.S. consumption chains, and indirectly, energy producers in the Gulf whose exports are dollar-denominated and demand-sensitive. What was revealed is not merely the rate, 15%, but the intent. The language framing the move emphasized economic sovereignty, supply chain resilience, and strategic autonomy. That vocabulary matters. It signals permanence rather than temporary pressure. Why does this change the situation? Because tariffs at this scale alter global pricing structures. A 15% blanket increase does not simply pressure a single trading partner. It recalibrates supply chains, currency flows, and industrial planning cycles. It also injects uncertainty into a moment already defined by geopolitical friction, including heightened tensions between the United States and Iran, naval drills involving Russia and China in proximity to key energy corridors, and renewed risk premiums in oil markets. Trade policy is rarely isolated. It interacts with deterrence, with alliance politics, with energy security. This alters the risk calculus. At first glance, tariffs are economic tools. But in modern statecraft, economic pressure and military positioning are deeply intertwined. Consider the Strait of Hormuz. Roughly 20% of global petroleum liquids transit this 33-kilometer-wide choke point at its narrowest navigable channel. Iran's anti-access area denial, A2AD network, includes coastal anti-ship missiles with ranges estimated between 120 and 300 kilometers, fast attack craft capable of swarm tactics, naval mines deployable from small vessels, ballistic missile systems with ranges exceeding 1,000 kilometers capable of targeting regional bases. The United States maintains carrier strike groups capable of projecting power hundreds of nautical miles inland, supported by destroyers equipped with Aegis combat systems, Standard missile interceptors, and Tomahawk cruise missiles with ranges of approximately 1,600 kilometers. Why does this matter in a tariff discussion? Because economic escalation often precedes or accompanies military signaling. When tariffs rise, affected states respond, sometimes economically, sometimes strategically. Russia and China have conducted joint naval exercises with Iran in recent years. While limited in scale, these drills demonstrate interoperability and political signaling. A Chinese Type 052D destroyer, for example, carries vertical launch systems capable of deploying long-range surface-to-air missiles. Russian frigates operating in similar exercises bring anti-ship cruise missile capabilities exceeding 300 kilometers in range. Most analysts focus on stock charts, Few are examining force posture adjustments that quietly follow economic rupture. Military planners are recalculating supply chain vulnerability for precision-guided munitions, rare earth components, and semiconductor-dependent systems. A prolonged tariff regime could disrupt dual-use technology flows critical to advanced weapons systems. The military equation has changed, not because missiles are flying, but because industrial foundations are shifting. For the United States, a 15% global tariff is both defensive and coercive. It seeks to incentivize domestic production while pressuring competitors. But it also risks alienating allies whose industries are caught in the crossfire. China interprets broad tariffs not as temporary bargaining tools, but as containment strategy. Beijing's response may include targeted export controls on rare earth elements, acceleration of yuan-denominated trade mechanisms, expanded energy agreements with Gulf producers. Russia, already operating under sanctions, views tariff fragmentation as validation of economic bloc formation. Moscow benefits from disorder in Western trade cohesion. Iran, observing from the Gulf, sees opportunity. Higher oil prices, driven by risk premiums and potential supply disruption, increase revenue. Tensions in the Strait of Hormuz become more strategically valuable. How does this change deterrence? Deterrence is not only about military capability, it is about economic resilience. If global trade fractures into blocs, military alliances often follow. The strategic balance is shifting from globalization toward securitized trade networks. Military planners are recalculating logistics chains, how quickly fuel, spare parts, and munitions can be sourced under tariff pressure. War games increasingly incorporate supply chain interruption scenarios alongside kinetic strikes. Domestically, the tariff announcement intersects with political timelines and legislative oversight. Congressional reactions are divided. Some lawmakers argue tariffs protect domestic industry. Others warn of inflationary pressure and retaliation. Internationally, allies seek clarity. European capitals are weighing countermeasures. Asian trading partners are assessing World Trade Organization mechanisms and bilateral responses. Deadlines matter. If tariffs take effect within weeks, supply contracts will be renegotiated immediately. Shipping manifests will shift, inventory stockpiling will accelerate, the window for negotiated compromise narrows as public rhetoric hardens, diplomatic channels remain open, but they are strained. Markets responded swiftly. Equities slipped as investors priced in margin compression. Import-dependent sectors, retail, consumer electronics, automotive manufacturing, face cost increases that cannot be fully absorbed. Gold rose as a hedge against policy-driven volatility. Oil markets are particularly sensitive. If tensions in the Strait of Hormuz escalate alongside tariff disputes, crude prices could spike sharply. Even a temporary disruption through naval harassment, insurance premium increases, or tanker rerouting would raise global energy costs. Higher oil feeds into transportation costs. Transportation feeds into food prices. Food prices feed into inflation expectations. Central banks, already navigating delicate interest rate paths, face renewed complexity. For the average citizen, the impact is tangible. Higher fuel prices, more expensive imported goods, volatility in retirement portfolios, potential job shifts as supply chains reconfigure. This is how geopolitical tension translates into household economics. The next 48 hours are critical. Watch for naval movements, satellite tracking of carrier strike groups in the Fifth Fleet's area of responsibility. Any unusual concentration near the Strait of Hormuz signals heightened alert. Airspace activity increased ISR, intelligence, surveillance, reconnaissance, flights over Gulf waters. Official statements, language from Beijing, Brussels, and Tehran. The tone will indicate whether this is bargaining or structural escalation. Market indicators, Brent crude breaching technical resistance levels, Gold sustaining above breakout thresholds. Volatility indices spiking beyond recent averages. Shipping insurance rates. A sudden rise in war risk premiums for Gulf transit would confirm market fear of physical disruption. The clock is ticking. Is this a preview of larger confrontation? Possibly. Economic fragmentation historically precedes strategic realignment. The interwar period of the 1930s saw tariff escalation contribute to bloc formation. While today's institutions are more robust, the risk of trade weaponization remains significant. If tariffs persist and retaliation expands, the world could drift toward parallel economic systems, one U.S.-centered, one China-centered, with Russia and regional actors aligning opportunistically. Future wars, if they occur, will not be fought solely with tanks and aircraft. They will be fought through semiconductor access, rare earth supply, energy choke points, and digital infrastructure. The strategic balance is shifting toward economic resilience as a pillar of national defense. This alters the risk calculus for every major power. The 15% tariff framework is not just a policy line item, it is a signal that the era of frictionless globalization is fading, a signal that economic tools are being integrated into strategic doctrine, a signal that trade disputes can rapidly intersect with military posture and energy security. The window for de-escalation exists, but it is narrowing. Markets are adjusting, militaries are recalculating, diplomats are maneuvering. The next 72 hours will reveal whether this is leverage for negotiation or the beginning of a deeper structural divide. Uncertainty defines this moment, and in geopolitics, uncertainty is rarely neutral. Subscribe for every update. The next 72 hours will tell us everything.